My name is Aditya Dalal, and I am a senior studying mathematics and computer science.
Hi, my name is Danny Silverstein. I'm a senior in applied mathematics with a minor in computer science.
Hello, my name is Anton Charov. I'm a senior studying computer science.
Hi everyone, my name is Son Haja. I am a Math and CS major graduating in May 2026.
I worked on the CME parsing and ETF arbitrage this project. So as you can see on the screen, I used the SVE tool to generate some header files based off of CME's XML files. I used these header files to then generate more efficient and accurate parser code. And one of the challenges I faced was the fact that in some of these PCAPs, the extracted size was around 100 to 300 gigabytes, which just wasn't feasible in a virtual machine where other students were also trying to extract PCAP data. And so what I did to get around this was to stream the extracted input directly into my parsers and reduce RAM usage while still maintaining an accurate and efficient parsing procedure.
So getting into the NASDAQ parser. For NASDAQ, we used their Total View Itch 5.0 protocol, which is just a binary feed that is sent over UDP, specifically mold UDP 64, where every message represents an order book event. And when getting to the actual message payload itself from NASDAQ, they all start with one byte types like add, cancel, execute, but they're always followed by a fixed binary payload that has useful info like price, order ID, and all these other essential details you need to reconstruct and be able to parse this data. And the way we processed these PCAP files from Data Bento is simply get past that network header and get into the actual itch message. And we were able to track this at a per order level, which is level 3. But our strategies involved more so looking at the depth of market data. So that level 3 was converted into a level 2 price level depth. And the way this was done is by looking at all the different order type events and then logically mapping it to a price update, whether it be a change order or add order or move. And the reason for this was to make it compatible with the Strategy Studio text tick reader in order to preserve timing, order flow, and execution. And so this resulted in tick by tick market reconstruction.
Once we actually had this NASDAQ data, we need to combine it with the IEX data. So using the professor's IEX parser, we parsed IEX data for the USO ETF. We then merged the IEX and NASDAQ data based on message timestamp and made sure that this merged data was now in the text tick type for Strategy Studio. So now we actually have this merged data, but so what? The purpose of this was for the venue arbitrage trading strategy. This was our main trading strategy this semester. What this basically capitalizes on is buying low and selling high on opposite exchanges or vice versa. You're taking advantage of small price discrepancies between the order books of different exchanges. This visual perfectly depicts it. We're looking for small 1 cent spreads between the exchanges, seeing where we can get quick money quick. This could be due to things like liquidity or the IEX speed bump, for example. The main strategy was the venue arb double strategy. Basically what this did is it went long and short on opposite exchanges, taking out the best bid or the best ask for the arbitrage. And this ultimately left us with high P&L and very, very many trades. And it left us not being long or short after the fact and being perfectly set up for later arbitrages.
All right, one of our other variations on the trading strategy was the aggressive venue arb strategy. Now, one of our worries was that we weren't sending that many orders, and then the other one is that we're sending too much orders. So in the aggressive variation of the venue arb strategy, we only trade when our last arbitrage opportunity actually changed direction, because that way we avoid hitting the same arb, same quote, avoid sending the same load of orders, which results in confusion and unpredictability, which we don't like. And secondly, we want to actually be filled. So we experimented with increasing the aggressiveness of the strategy while sacrificing, of course, our potential profits. So this resulted in us at the same time getting more trades, but then less trades because of the forced direction change. All right, moving on to our next variation of our venue arb strategy, and that is the persistent arb. Now, many times in the market, you'll see something that looks like arbitrage, but it's not. So with spread persistence, we're really testing whether that arbitrage holds for at least 3 kinds of these opportunities, and then we go into the market. And there's many reasons for these spreads to even appear because people are constantly canceling their orders, liquidity showing up, there's some data feed timing difference, all these different factors at play. And so by maintaining that arb window for a longer time, we sort of reduce that noise. And anyways, this is better considering fee structure because we're not just sending random orders that are costing us.
I designed the ETF arbitrage strategy to capture inefficiencies between ETFs like USO and its underlying baskets such as crude oil futures. And the goal was to build a market neutral strategy that profits from the spread and not the direction of the market. Strategy works in 3 steps, which is fair value, where we listen to the basket's data feed to calculate a real-time fair value for the ETF. Venue scanning, where instead of just scanning orders blindly, the strategy iterates through all available market centers like CME, IEX to find the absolute best bid on us. And when the market price deviates from our fair value by set threshold, we enter a trade to capture the difference. The result is a strategy that acts as a liquidity provider, buying when the market is fearful and selling when it's greedy while automatically managing its own risk profile.